Before we dive in, please remember that I am not a licensed insurance agent or a financial advisor. This video is for educational and informational purposes only and does not constitute financial or legal advice. The information presented is based on general principles of insurance in the United States and may not apply to your specific situation. Always consult with a qualified, licensed professional in your state to discuss your individual business needs. Let's talk about a mistake. A tiny, innocent mistake that could cost you your house, your savings, and the business you've poured your entire life into. It's a mistake millions of American business owners are making right this second, and they have absolutely no idea. Picture this. It's a Tuesday morning. Your best employee, we'll call him David, is driving to a client meeting. On the way, he makes a quick stop at the bank to deposit a check for your business. It's not even a detour, the bank is right on his route. He's driving his own trusty sedan, the one he uses to pick up his kids from soccer practice. Then it happens. A moment of distraction, a slippery road, a car that stops short. It's a serious accident. The other driver is injured. Police are on the scene, reports are filed, and insurance companies are called. You feel terrible for David and the other person, but a part of you is relieved. David has great personal auto insurance. He's covered. You're covered. Everything will be okay. Except it won't. Because when David's insurance adjuster asks him one simple question, "Where were you going?" And David, being an honest guy, replies, "I was on my way to a client meeting after making a business deposit," the entire situation implodes. The adjuster types a few notes, and a few days later a letter arrives. It's a denial of claim. The reason? A little-known clause buried deep in David's personal auto policy called the business use exclusion. In that one moment, the financial shield you thought you had vanishes. And because David was acting on behalf of your company, the injured party's lawyer isn't just coming after David. They're coming after you. They're coming after your business. They're coming after your business assets and very likely your personal assets too. That one tiny errand, that simple bank deposit, has just triggered a potential multi-million-dollar lawsuit that could wipe you out completely. This scenario isn't some scare tactic. It is the single most overlooked catastrophic risk for small business owners in America today. And that is exactly what we are going to solve in this video. This is your definitive guide to understanding commercial auto insurance. By the end of this presentation, you will know with 100% certainty whether your business is dangerously exposed, and you will know exactly what to do about it. We will demystify the jargon, we will break down who needs it, what it covers, what it doesn't cover, and how it can be the one thing that saves your business from financial ruin. Now, I know what some of you are thinking. I have an LLC. I have an S-Corp. My personal assets are protected by the corporate veil. That is one of the most dangerous assumptions a business owner can make. While a corporate structure does offer a layer of protection, that veil can be, and often is, pierced, especially in cases of negligence. If you or an employee acting on your behalf cause an accident, a skilled attorney will argue that the business owner was negligent in not providing the proper insurance coverage for business activities. And when that happens, the line between your business and your personal life blurs frighteningly fast. Suddenly, your home, your retirement savings, your kids' college funds, it's all on the table. The fundamental problem is this. Personal auto insurance and commercial auto insurance are built on two completely different worlds of risk. Your personal auto policy is designed for your personal life. It's priced and underwritten based on you driving to the grocery store, taking the kids to school, and going on a weekend road trip. The insurance company has calculated the risk based on predictable, non-commercial patterns. The second you introduce a business purpose, the entire risk profile changes. Think about it from the insurer's perspective. When a vehicle is used for business, it's often on the road more frequently, increasing the sheer statistical probability of an accident. It might be driven during peak traffic hours, in unfamiliar areas, or by employees who may have different driving habits than you. It could be carrying tools, equipment, or products that increase its weight and change its handling. It could be transporting clients or other employees, which introduces a whole new level of liability. A pizza delivery driver is a much higher risk than someone commuting to a single office location. A contractor's truck loaded with thousands of dollars in tools and materials is a fundamentally different risk than a family minivan. A real estate agent driving clients to view properties is not the same as driving friends to the movies. Personal auto insurance companies know this. They are not in the business of covering commercial risks, which is why nearly every single personal policy in the United States contains that business use exclusion clause. It's their legal escape hatch. So what exactly counts as business use? This is where so many entrepreneurs get tripped up. It's not just about having a big truck with your logo plastered on the side. The definition is incredibly broad. Are you a freelance photographer driving to a shoot? That's business use. Are you a caterer delivering an order? Business use. Are you a consultant driving to a client's office? Business use. A handyman driving to Home Depot to pick up supplies for a job? Business use. A rideshare or food delivery driver. That's a whole category of business use in itself. Even something as simple as having a magnetic sign for your business that you stick on your car door can be enough for some insurance companies to deny a claim. The line is this: if the primary purpose of your trip is to earn income or further your business interests, you are engaging in business use. Your personal policy is not designed to cover you for that. It's a gamble. You are betting your entire financial future against the odds of never having an accident while on the clock. And with over 6 million car accidents in the US every year, those are not good odds. The financial consequences are staggering. Let's move beyond a simple fender bender. Imagine a serious accident where someone is permanently disabled. The medical bills alone could exceed $1 million. Add to that lost wages, long-term care, pain and suffering, the settlement or judgment could easily reach $2, $3, or even $5 million. Your personal auto policy might have liability limits of, say, $100,000 or $300,000. But if the claim is denied because of business use, your coverage is zero. You are responsible for the entire multi-million-dollar judgment yourself. This is why commercial auto insurance exists. It's not just car insurance for businesses. It is a foundational pillar of asset protection. It's designed specifically to handle the higher risks and, critically, the higher liability limits that businesses require. A standard commercial auto policy often starts with a $1 million liability limit and can go much higher. It's built to withstand the kind of catastrophic financial blow that would instantly bankrupt a business relying on personal insurance. It's the difference between a lawsuit being a manageable business expense versus an extinction-level event. Over the next few minutes, we are going to break down every single aspect of this. We will explore the specific types of vehicles that need coverage, from sedans to heavy-duty trucks. We'll talk about employees, whether they're driving company cars or their own personal vehicles on your behalf. A massive area of risk called non-owned auto liability. We will dissect the different types of coverage available, from liability and collision to specialized coverage for tools, equipment, and cargo. And most importantly, we will give you a clear, actionable checklist so you can walk away from this video and immediately determine your own level of risk. This isn't just about avoiding a denied claim. It's about building a fortress around the business you've worked so hard to create. So let's start by building the first wall of that fortress. And to do that, I want to tell you a quick story about a woman named Maria. Maria runs a small but successful catering business. For 3 years, she's poured her heart, soul, and savings into it. She started with just a few clients, mostly friends and family, but word of her amazing food spread like wildfire. Now she's busy, booked almost every weekend. Her pride and joy, besides her cooking, is her minivan. It's her personal vehicle, the one she uses to take her kids to soccer practice and go to the grocery store. But it's also her workhorse. She loads it up with chafing dishes, trays of food, and all the tools of her trade. It's perfect. It's paid off. And she has, in her words, great insurance, full coverage, low deductible. She's been with the same company for a decade. She feels protected. One Friday afternoon, she's on her way to deliver a large order for a corporate lunch. She's driving carefully, cruising through a green light in a busy intersection, when another driver, trying to make a left turn, misjudges the gap and pulls right out in front of her. Bam! It's not a horrific crash, but it's bad enough. Her front end is crumpled, the other car's side is caved in. Airbags deploy. Everyone is shaken up, but thankfully, nobody seems seriously injured. The police come, a report is filed, and the other driver is clearly at fault. Maria calls her insurance company from the side of the road, relieved that this messy situation will soon be over. She's done everything right. A few days later, an adjuster calls. The conversation starts normally. He's friendly, asks how she's feeling, goes over the details of the police report. It all seems routine. And then he asks the question, the simple, innocent-sounding question that changes everything. He says, "So Maria, can you just tell me where you were headed at the time of the accident?" And Maria, being an honest person, tells the truth. "I was on my way to a client's office." I was delivering a catering order for my business. There's a slight pause on the other end of the line. The friendly tone of the adjuster becomes a little more formal, a little more distant. And he says the words that every business owner using their personal vehicle dreads hearing. I see. Well, I'm afraid I have some bad news. Your policy doesn't cover this accident. Maria is in shock. She stammers. What do you mean? I have full coverage. The other guy was at fault. What are you talking about? The adjuster calmly explains that buried deep in the fine print of her personal auto policy is something called a business use exclusion, because she was using her vehicle in the act of conducting business, specifically transporting goods for a fee. Her personal policy is void for this incident. The entire claim is denied. Every last penny. The thousands of dollars to repair her minivan? That's on her. The rental car she needs to get around? Out of her own pocket. But it gets so much worse. A few weeks later, she gets a letter from an attorney. The driver of the other car, who initially seemed fine, is now claiming neck and back injuries. He's suing. And because her own insurance company has washed their hands of the situation, she has no liability coverage. No team of lawyers to defend her. Nothing. The lawsuit isn't just against her business. It's against her personally. Suddenly, the fortress she thought she had built around her life, her savings account, her home equity, her kids' college fund, is under direct assault. All because of one question and one very common, very dangerous misunderstanding. Now you might be sitting there thinking, okay, that's a scary story, but I'm not a caterer. I just use my truck to carry my own tools. Or, I'm a real estate agent, I just drive clients around. Or, I just make a few deliveries for my Etsy shop. I need you to understand this. The insurance company's definition of business use is incredibly broad, and it almost certainly includes what you're doing. They don't care if your business is a side hustle or a Fortune 500 company. To them, commerce is commerce. And the moment your vehicle is involved in it, your personal policy is likely off the hook. So let's get specific. Let's build that checklist I promised you. What exactly do insurers consider business use that could trigger a denial like Maria's? Number 1. Transporting goods or materials. This is the big one. If you are a contractor carrying tools and supplies to a job site, you need commercial auto. A plumber with pipes and wrenches in the back of his van. A carpenter with a ladder rack on his truck. A photographer with thousands of dollars of camera gear in her trunk on the way to a shoot. A baker delivering a wedding cake. All of it is business use. The logic is simple. The more time you spend on the road, and the more equipment you're carrying, the higher the risk. Number 2. Driving passengers for a fee. This is the most obvious one. If you're driving for Uber or Lyft, you know you need a special kind of policy. But this also applies to other businesses. A shuttle service for an airport. A non-emergency medical transport business. Even a daycare that uses a van to pick up children. If money is changing hands in exchange for a ride, that is a commercial activity. Number 3. Performing a service. Think about a mobile dog groomer, a landscaper who drives from lawn to lawn, a pest control technician, or a pool cleaner. The vehicle itself is an essential part of the service you deliver. You are constantly on the road, moving from one client to the next. That high mileage and frequent stop-and-go driving in various locations dramatically increases your risk profile compared to a standard commuter. Your personal policy was never priced or designed to cover that level of exposure. Number 4. Making sales calls or business-related errands. This is a sneaky one that trips up a lot of people. You're a sales consultant and you use your personal sedan to visit clients. You're a real estate agent showing properties. You're a manager running to the bank to make a business deposit, or to an office supply store to pick up toner. Even if the vehicle is empty, if the purpose of the trip is to generate income or further your business operations, it falls under the umbrella of business use. The question is always, would you be making this trip if not for your business? If the answer is no, you are in a danger zone. Number 5. Having employees operate the vehicle. This is a massive red flag for personal insurers. The second you hand the keys to an employee, even a trusted long-term one, and tell them to run a business errand, you have entered a new world of liability. You are now responsible for their actions behind the wheel. If they get into an accident while working for you, and you only have a personal policy, you can almost guarantee the claim will be denied. Insurers see this as an unacceptable risk because they haven't vetted or priced the policy for unknown drivers operating the vehicle for commercial purposes. And finally, number 6, towing a trailer used for business. If you hook up a trailer carrying your landscaping equipment, your construction materials, or your concession stand for the weekend market, that trailer and everything in it is part of your business. Most personal policies have strict limitations on trailers, and using one for commercial purposes is one of the fastest ways to get a claim denied. So take a mental inventory right now. Do any of those 6 scenarios apply to you? Even just one? Even just occasionally? Because that's all it takes. It's not about how often you do it. It's about whether you were doing it at the moment of the accident. Maria only had one accident, but that one time was enough to put everything she had ever worked for in jeopardy. The hard truth is that personal auto insurance is designed for one thing: getting you from your home to your personal activities, and maybe to a single, fixed place of work and back. It is not designed to be the backbone of a commercial enterprise. It's like using a garden hose to fight a house fire. It might feel like you're doing something, but when you actually need it, you'll find it's completely and dangerously inadequate. But the risk isn't just about what you're doing in the vehicle. It's also about the vehicle itself. The physical characteristics of your car, van, or truck can automatically disqualify it from personal coverage, even if you're just on your way to the grocery store on a Sunday morning. The lettering on the side, the custom shelving you installed, the type of ladder rack on the roof, these things scream commercial use to an insurer. And that's a trap that's even easier to fall into because it makes you vulnerable 24/7. We're going to break down that physical vehicle checklist next so you can see if your truck itself is a ticking time bomb for your insurance. Alright, let's start with the most straightforward test. The vehicle itself. Forget about who's driving, where they're going, or what they're doing for a moment. Just look at the car, van, or truck parked in your driveway. Sometimes the physical nature of the vehicle alone is enough to scream commercial to an insurance company, making your personal auto policy virtually useless from the get-go. First up, and this is a big one, vehicle weight. We're talking about the gross vehicle weight rating, or GVWR. This isn't how much the vehicle weighs empty. It's the maximum loaded weight it's designed to carry, including the vehicle itself, passengers, and all its cargo. You can find this number on a sticker inside the driver's side door jamb. Why does this matter so much? Because physics doesn't lie. A heavier vehicle carries more momentum and can cause exponentially more damage in an accident. Insurers know this, and they draw a very hard line in the sand. For most personal auto policies, that line is drawn around 10,000 pounds. If your vehicle's GVWR is 10,001 pounds or more, you are almost universally required to have a commercial policy. Period. This catches a lot of people by surprise, especially contractors, landscapers, or anyone who needs a heavy-duty truck. You might buy a Ford F-350, a Ram 3500, or a Chevy Silverado 3500 for your business. You use it just like you used your old F-150, maybe even driving it to the grocery store on weekends. But in the eyes of an insurer, that F-350 is a different class of beast entirely. Its potential for destruction is so much greater that a personal policy simply won't cover the risk. Imagine totaling a Tesla with a 1-ton dually truck versus a Toyota Camry. The damage, the liability, the medical bills, everything is magnified. So your first step is simple. Go open your driver's side door and read that sticker. If it says 10,001 pounds or more, you don't need to go any further down this checklist. You need commercial auto insurance. Next, let's talk about the vehicle's type and how it's equipped. This is where things get a little more nuanced. Certain vehicles are just presumed to be used for business because of their design. Think about a box truck, a dump truck, or a semi-tractor. No one's buying a Peterbilt for a family road trip. Those are obvious. But what about the less obvious ones? A cargo van is a perfect example. If you have a Ford Transit or a Ram ProMaster with no rear seats and it's primarily used to haul tools, equipment, or products, that's a commercial vehicle. The real trap here is vehicle modification. Let's say you're an electrician. You buy a standard minivan, a Dodge Grand Caravan. You take out the back seats and install permanent shelving and storage bins for your wires, conduits, and tools. You've just fundamentally altered the vehicle's purpose. It's no longer a passenger vehicle. It's a mobile workshop. A personal auto insurer will look at that and say, this vehicle is not being used as the manufacturer intended for personal use. It has been upfitted for a specific trade. If you get into an accident, and the claims adjuster sees that custom interior, they have every right to deny your claim because the risk they agreed to cover, a family minivan, is not the risk you were actually presenting, a commercial work vehicle. The same goes for a plumber with custom pipe racks, a painter with built-in ladder storage, or a caterer with permanent food warmers installed. If you've modified your vehicle to do a job, it needs a policy that's designed for a job. Third on our physical checklist is one of the most common and easily proven triggers: signage. The moment you put a logo, your business name, or a phone number on your vehicle, you are advertising to the world, and more importantly to every insurance company, that this vehicle is used for commercial purposes. It's a rolling billboard. Think about it from the insurer's point of view. They see a vehicle with Dave's Plumbing 555-1234 on the side. Their immediate assumption isn't that Dave is on his way to a picnic. Their assumption is that Dave is on his way to or from a job, generating revenue, and operating as a business. This creates a much higher risk profile. A branded vehicle is likely on the road more often, driving in unfamiliar areas, parking in commercial zones, and carrying tools or equipment that could be stolen. It doesn't matter if the sign is a professional vinyl wrap or a cheap magnetic sign you slap on the door. In the event of an accident, that sign is Exhibit A in the case against your personal policy coverage. The other driver's lawyer, the police report, the photos from the scene, they will all feature your business name. It's an open and shut case for the insurance company to deny the claim based on misrepresentation of use. You told them it was a personal car, but you were advertising it as a business tool. You can't have it both ways. If you want to brand your vehicle to get more customers, you have to accept the responsibility that comes with it and get the proper commercial insurance. Fourth, consider what your vehicle is designed to haul or tow. This is closely related to weight, but it's more about the specific function. If your truck is equipped with a fifth-wheel hitch to pull a heavy-duty trailer for your excavation business, that's commercial. If you have a pickup with a permanently installed snowplow attachment on the front, that's a commercial vehicle, even in the summer when the plow is in your garage. Why? Because the vehicle has been modified and equipped for a specific type of commercial work. Think about towing. Towing your personal boat to the lake on a Saturday is a personal use. Towing a trailer loaded with zero-turn mowers and weed whackers from one client's lawn to the next is commercial use. The risk is completely different. The trailer itself adds length and weight, making the vehicle harder to maneuver and stop. The contents of the trailer, expensive commercial equipment, add a new layer of liability. What if your trailer detaches and hits another car? What if your mowers aren't secured properly and fall onto the highway? A personal policy is not designed to handle the liability of a mobile business operation. It's designed for you, your family, and your personal belongings. A trailer full of commercial equipment is not a personal belonging. Finally, there's a catch-all category of other attached equipment. This is similar to modifications but focuses on external, job-specific hardware. Do you have a permanent ladder rack on your van or truck? That signals to an insurer that you're likely a contractor, a roofer, or a painter. Do you have a hydraulic lift gate on the back of your truck? That's for moving heavy goods, a clear business function. What about a custom-built utility body with multiple toolboxes and compartments instead of a standard pickup bed? That is unequivocally a work truck. Each of these additions tells a story about the vehicle's primary purpose. And if that purpose is to make money, you're in commercial territory. So take a hard look at your vehicle. Is its GVWR over 10,000 pounds? Is it a type of vehicle like a cargo van primarily used for work? Have you modified it with things like shelves or bins? Does it have any kind of sign or logo on it? Is it equipped to tow heavy commercial trailers or outfitted with equipment like a plow or a ladder rack? If you answered yes to even one of these questions, you are waving a massive red flag. You are giving your personal insurance company a simple, undeniable, physical reason to reject a claim. And a rejected claim can be financially devastating. But here's the most dangerous part. Maybe you've gone through this entire checklist and your vehicle is clean. It's just a standard, unmodified Ford F-150 under the weight limit. No logos, no special equipment. You think you're completely safe. You're not, because we've only looked at the vehicle. We haven't talked about the most critical factors of all: who is driving it, what they are carrying, and why they are on the road in the first place. This is where the lines get incredibly blurry, and where the most expensive mistakes are made. What happens the moment you ask an employee to run a simple errand in that truck? That's where your personal policy can vanish in a puff of smoke. And when we say puff of smoke, we're not being dramatic. We're describing the exact moment your insurance provider invokes the business use exclusion clause buried deep within the fine print of your personal auto policy. This is the single most misunderstood and financially catastrophic aspect of vehicle insurance for small business owners. Let's unpack that scenario. You have a pickup truck. It's insured under your personal name. You primarily use it for weekend trips to the hardware store for your own home projects and for driving to and from your office. This is commuting, and your personal policy is perfectly happy with that. But one Tuesday afternoon, your foreman calls. They're short on a specific type of copper fitting at a job site across town. You look at your new employee, a young guy named Kevin, and say, "Hey Kevin, can you do me a huge favor? Take my truck, run over to the supply house on Elm Street, and grab a box of those fittings. Here's the company card." Kevin, being a great employee, says, "Sure thing, boss," grabs the keys and heads out. 10 minutes later, as he's making a left turn, another driver runs a red light and T-bones him. It's a bad accident. Your truck is totaled, the other car is crumpled, and both Kevin and the other driver are headed to the hospital with serious injuries. It's a nightmare scenario, but you think, "Thank God I have insurance. I have $1 million liability limit. We're covered." You call your personal auto insurance agent. You explain what happened, and then you hear the 5 words that will change your life. "He was on the clock?" You say, "Well, yeah, he was running an errand for the business." And that's when the floor drops out from under you. The agent on the other end of the line will say something polite but firm, like, "I'm very sorry to hear about the accident, but your policy does not provide coverage for vehicles being used for commercial purposes. We will be denying the claim." In that instant, you are on your own. Your $1 million personal liability shield has vanished. Why? Because the moment Kevin got behind the wheel to perform a task for your business, the nature of the risk changed completely. Your personal policy was priced and underwritten based on the risk of you driving to work, to the grocery store, on vacation. It was never designed to cover the risks of an employee operating a vehicle in the service of a for-profit enterprise. Many business owners fall into this trap because they misunderstand something called permissive use. Most personal auto policies have a permissive use clause, which generally states that if you give someone permission to drive your car, they are covered by your insurance. So, if you let your friend borrow your truck to help them move a couch, and they get into an accident, your policy typically steps in. The mistake is assuming this permission extends into the commercial world. It does not. The business use exclusion overrides the permissive use clause. The insurer's logic is simple. If the primary purpose of the trip is to benefit the business, it's business use. Period. Let's look at how deep this rabbit hole goes. It's not just about employees driving your company-owned vehicle that's personally insured. The far more common and equally dangerous scenario involves employees using their own vehicles for your business. This is where hired and non-owned auto coverage comes into play, but we'll get to that later. For now, let's stick to the core problem. Imagine you own a small consulting firm. Your top salesperson, Sarah, drives her own Honda Accord to meet clients several times a week. You reimburse her for mileage. One day, on her way from one client meeting to another, she glances at her phone, misses a stop sign, and causes a multi-car pileup. People are injured. The lawsuits start flying. Who pays? Sarah's personal auto insurance is the first line of defense. But her insurer's lawyers are going to ask some very pointed questions. Where were you going, Miss Smith? I was driving from an appointment with Acme Corp to a meeting with Globex Incorporated. And does your employer XYZ Consulting reimburse you for this travel? Yes, they do. Ding ding ding. The insurance company's lawyers have just found their escape hatch. They will argue that because Sarah was acting as an agent of your business, conducting company business, her personal policy shouldn't apply. They may offer her state minimum liability limits and then wash their hands of the rest, or they may deny the claim outright, citing the business use exclusion. Now, the injured parties and their very aggressive attorneys are looking for someone with deeper pockets to sue. And who is that? You. Your business. They will sue Sarah personally, and they will absolutely sue your company under a legal doctrine called vicarious liability, which holds an employer responsible for the actions of its employees while they are on the job. So now, a lawsuit that could easily reach hundreds of thousands, if not millions of dollars, is aimed directly at your business bank accounts, your assets, everything you've worked to build. And because you don't have a commercial auto policy, you have no insurance company lawyers to defend you, no liability coverage to pay the settlement or judgment. You're paying for a top-dollar legal defense out of your own pocket, all while the potential judgment hangs over your head like a guillotine. This is how businesses are destroyed. A simple, everyday task, an employee driving to a meeting, can be the single event that bankrupts a company. The distinction between commuting and business use is another critical landmine. Driving to your first work-related stop of the day, and driving home from your last stop of the day, is generally considered commuting. Your personal auto policy is fine with that. But any driving that happens between those 2 points for a work purpose is business use. Let's make it crystal clear. Driving from home to the office? Commuting. Driving from the office to a client lunch? Business use. Driving from that client lunch to a post office to mail company packages? Business use. Driving from the post office to a job site to check on progress? Business use. Driving from that job site back to the office? Business use. Driving from the office back home? Commuting. That entire chain of trips in the middle of the day, the driving that actually generates revenue and keeps your business running, is precisely what your personal auto policy is designed to run away from. Think about all the ways this can manifest. The real estate agent showing houses, the caterer driving to an event, the IT consultant driving to a client's office to fix a server, the florist delivering an arrangement, the contractor picking up supplies. Even an office manager using their own minivan to go to the bank to deposit company checks is engaging in business use. In every single one of these scenarios, relying on a personal auto policy is like playing Russian roulette with a fully loaded chamber. The policy is a phantom. It gives you the illusion of protection, but when you actually need it, it won't be there. The risk you thought you had transferred to an insurance company comes crashing right back onto your shoulders, and the shoulders of your business. It's a fundamental misunderstanding of risk, and it's time to understand what real protection actually looks like. So let's build that fortress. Let's draw the blueprint for what true commercial auto insurance is, because it's not a single monolithic thing. It's a package of different coverages, each one a stone in the wall, a bar on the window, designed to protect you from a specific type of financial catastrophe. And the absolute bedrock, the foundation upon which everything else is built, is liability coverage. This is the big one. This is the coverage that protects you from the rest of the world when you, or your employee, cause an accident. It's broken into two critical parts: bodily injury and property damage. Let's make this real. Imagine your employee, let's call her Maria, is driving your company's Ford Transit van to a job site. She's a great employee, responsible, never had an issue. But for 1 second, just one, she glances down at the GPS on her phone. In that 1 second, the car in front of her, a brand new Mercedes SUV, slams on its brakes. Maria hits it hard. The force of the impact shoves the Mercedes into a crosswalk, where it clips a pedestrian. Suddenly, you don't have one problem. You have a cascade of them. The owner of the Mercedes is furious. The repair bill for his high-tech, sensor-filled SUV is $35,000. That's property damage liability. Your personal auto policy might cap out at $25,000. You're already $10,000 out of pocket, and we haven't even gotten to the worst part. The driver of the Mercedes has severe whiplash and a herniated disc. His medical bills, physical therapy, and lost wages from his high-paying job quickly soar past $100,000. The pedestrian has a broken leg and a concussion. Her medical transport, hospital stay, surgery, and rehabilitation will easily cost over $250,000. And that's before either of them decides to sue your business for pain and suffering, which they absolutely will. This is bodily injury liability, that $50,000 or $100,000 limit on your personal policy. It's not a speed bump, it's a puff of smoke. It's gone in an instant. The lawyers for the injured parties won't stop there. They will come after your business. They will look at your revenue, your assets, your equipment, your future earnings. They will put a lien on your business property. They will seize your bank accounts. Everything you've worked to build can be dismantled to pay a judgment that far exceeds your flimsy personal policy limits. A standard commercial auto policy, however, doesn't start at $50,000. It typically starts with a combined single limit of $1 million. $1 million. It's a number that sounds huge, but in the face of a severe accident, it's not excessive, it's necessary. It's the difference between your insurance company writing a very large check and you handing over the keys to your business. Liability coverage isn't for you. It's for everyone else you might accidentally harm, and in protecting them, it ultimately protects you from total financial ruin. Okay, so the world outside your vehicle is protected. But what about the vehicle itself? Maria's Ford Transit van is crumpled. The frame is bent. It's a total loss. That's a $40,000 asset that's now sitting in an impound lot. This is where the next layer of your fortress comes in: physical damage coverage. This is also split into two parts. The first is collision coverage. It's exactly what it sounds like. It pays to repair or replace your vehicle if it's damaged in a collision with another object. Another car, a pole, a guardrail. It doesn't matter who was at fault. Even though Maria caused the accident, with collision coverage you file a claim, you pay your deductible, say $1,000, and the insurance company cuts you a check for the actual cash value of your totaled van. Without it, you're just out of van. You have to drain your cash reserves or take out a loan to buy a new one, all while you're trying to keep your business running. Collision coverage is business continuity insurance. It gets your wheels back on the road so you can get back to making money. The second part of physical damage is comprehensive coverage. This is the protection against almost everything else that isn't a collision. Think of it as the life happens coverage. A freak hailstorm pummels your truck, leaving it looking like a golf ball. That's a comprehensive claim. A thief smashes your window and steals the truck from your shop overnight. Comprehensive. You're driving on a rural road and a deer leaps out of the woods, destroying your front end. Comprehensive. A tree branch snaps in a windstorm and crushes the roof of your parked car. Comprehensive. It covers fire, floods, vandalism, and falling objects. It's the coverage that protects your assets from the random, chaotic events of the world that have nothing to do with your driving. For a business where a vehicle is a vital piece of equipment, losing it to a random act can be just as devastating as losing it in a crash. So now we've protected the world from you, and we've protected your vehicle from the world. But what about the people inside your vehicle? What about Maria? This brings us to the next essential coverages: medical payments and uninsured motorist. Let's start with medical payments coverage, often called MedPay, or in some states, personal injury protection or PIP. This is your no-fault, first response medical coverage. In the accident, Maria sustained a broken wrist and some bad bruises. MedPay covers her ambulance ride, her emergency room visit, her x-rays, and her follow-up doctor appointments, up to a set limit, say $5,000 or $10,000. The most important part is that it pays right away, regardless of who was at fault. You don't have to wait for a long investigation to determine liability. It's a financial first aid kit that ensures your employees get the immediate care they need without worrying about the bills. It shows you're a responsible employer, and it can help head off more complicated and expensive workers' compensation claims down the line. Now for the last piece of this core structure, and it might be the most underrated hero in the insurance world: uninsured and underinsured motorist coverage. Let's change the scenario. This time Maria is driving perfectly. She stops at a red light, and a speeding driver plows into the back of her van. The other driver is clearly at fault, but when the police arrive, it turns out he has no insurance. Zero. He let it lapse. Or maybe he has the absolute bare minimum coverage his state requires, like $25,000, which won't even cover the repairs to your van, let alone Maria's mounting medical bills for her back injury. So who pays? The guy who hit you has no insurance and no money. Are you just out of luck? Not if you have uninsured motorist coverage. This coverage steps in and essentially becomes the insurance the other driver should have had. Pays for your vehicle repairs. It pays for your employees' medical bills and lost wages. It protects you from the irresponsibility of other people on the road. Underinsured motorist coverage works similarly, kicking in when the at-fault driver has insurance, but not enough to cover the full extent of the damage and injuries. In a country where 1 in 8 drivers is uninsured, going without this coverage is like leaving the main gate of your fortress wide open. Liability, collision, comprehensive, medical payments, and uninsured motorist. These aren't just confusing insurance terms. They are the 5 foundational pillars of real commercial auto protection. They form a complete, 360-degree shield around your vehicle, your driver, your assets, and your entire business. But this is just the standard blueprint. What about the thousands of dollars of tools and equipment inside the van? What happens when your vehicle is in the shop for 2 weeks and you can't do any jobs? That requires moving beyond the foundation and adding custom fortifications. These fortifications are the specialized coverages that plug the specific, and often devastating, gaps that a basic policy leaves wide open. Let's start with one of the most terrifying scenarios for any driver: the phantom menace. Imagine you're driving your fully branded plumbing van to an emergency call. You're stopped at a red light, minding your own business, when bam, a speeding sedan rear-ends you hard. The driver is clearly at fault. Your van is damaged, your neck is killing you, and you're going to be late. The other driver apologizes profusely, but when you exchange information, he sheepishly admits he doesn't have insurance. Or, almost as bad, he has the absolute bare minimum coverage required by the state, maybe $15,000. Your van repairs alone will cost $10,000, and your medical bills are already piling up. His tiny policy won't even make a dent. You're a victim, yet you're stuck holding the bag for tens of thousands of dollars in damages and medical expenses. This is where your first fortification comes in: uninsured and underinsured motorist coverage. It's often shortened to UM/UIM. This coverage is your secret weapon. When the at-fault driver has no insurance or not enough insurance, your own policy steps in and acts like their insurance. It pays for your vehicle repairs, your medical bills, and even your lost wages, up to the limits you select. In the United States, it's estimated that 1 in 8 drivers is uninsured. That's a roll of the dice every single time your vehicle pulls out of the driveway. Skipping uninsured motorist coverage isn't saving money. It's placing a blind bet that every other driver on the road is as responsible as you are. That's a bet most businesses can't afford to lose. Next, let's talk about immediate medical needs. After an accident, fault isn't determined instantly. It can take weeks, even months, for insurance companies to investigate and lawyers to argue. But injuries don't wait for paperwork. This is where medical payments coverage, or MedPay, comes in. In some states, it's a similar, more comprehensive version called Personal Injury Protection, or PIP. Think of this as your company's on-call paramedic. Regardless of who was at fault for the accident, MedPay or PIP immediately starts paying for the medical expenses of you and any passengers in your commercial vehicle. We're talking ambulance rides, emergency room visits, x-rays, and doctor's appointments. It's a relatively inexpensive coverage that provides incredible peace of mind, ensuring your team gets the care they need right away, without having to worry about who is ultimately going to pay the bill. It keeps a bad situation from getting worse while the bigger liability questions get sorted out. Now, I need you to listen very, very closely, because the next type of coverage we're going to discuss is arguably the single most overlooked, misunderstood, and catastrophically important endorsement for modern American businesses. It's called Hired and Non-Owned Auto Liability, or HNOA. This sounds like boring insurance jargon, but I promise you, understanding this could be the one thing that saves your entire business. Let's paint a picture. You own a growing catering company. You have one dedicated delivery van which is properly insured. But it's a busy Friday, and you get a last-minute order for a big corporate lunch downtown. The van is already out on another delivery. So you turn to your star employee, Mike. You say, "Mike, can you do me a huge favor? Take your personal Honda Accord and run this lunch order over to the law firm on 5th Street. I'll reimburse you for gas." Mike, being a great employee, says, "No problem, boss." He loads up the food, gets in his own car, and heads downtown. On the way, he gets a text. He glances down for just a single second, and rear-ends a brand new Mercedes. The damage is significant, and the driver of the Mercedes gets a nasty case of whiplash. Here's where the nightmare begins. The Mercedes driver sues. Mike calls his personal auto insurance company. The first question the insurance adjuster asks is, "What were you doing at the time of the accident?" Mike honestly replies, "I was delivering a catering order for my boss." The adjuster's tone immediately changes. He says, "I'm sorry, Mike, but your personal auto policy has a business use exclusion. We do not cover accidents that occur while the vehicle is being used for commercial purposes. Your claim is denied." Panic sets in. The lawsuit, now for $200,000, lands on Mike's doorstep. But his lawyer tells him something even more terrifying. Since he was acting on behalf of your business, the primary target of the lawsuit isn't him. It's you. It's your company. Suddenly, your catering business is on the hook for a massive lawsuit, all because you asked an employee to make a 10-minute delivery in his own car. Your standard commercial auto policy won't cover it, because the accident didn't involve your insured company van. This is the exact business-ending scenario that hired and non-owned auto insurance is designed to prevent. Non-owned coverage protects your business when an employee uses their personal vehicle for work errands. Hired coverage protects you when you rent, lease, or borrow a vehicle for business use, like renting a U-Haul truck for a big job. If you or any of your employees ever, and I mean ever, use a personal vehicle for a work-related task, even something as simple as a run to the bank or the post office, you absolutely positively need HNOA coverage. It is not an option. It is essential life support for your business. Okay, let's move from the catastrophic to the practical. Remember the question from before? What happens when your work truck is in the shop for 2 weeks after an accident? You can't work. You can't generate revenue. You're losing money every single day. This is where rental reimbursement, sometimes called transportation expense, is a lifesaver. For a very small additional premium, this coverage pays for you to rent a temporary replacement vehicle while yours is being repaired due to a covered claim. Keeps you on the road and on the job. Without it, you're stuck paying out of pocket for a rental, which for a commercial van or truck can be hundreds of dollars a day, or you're just closed. It's a simple fortification that protects your cash flow and prevents downtime. Similarly, there's towing and labor coverage. Does exactly what it says. If your work vehicle breaks down, gets a flat tire, or runs out of gas, this coverage pays for a tow to the nearest repair shop and for the basic labor costs at the scene. It's another low-cost, high-convenience add-on that saves you from being stranded and overpaying for an emergency tow. Finally, let's solve the mystery of the stolen tools. Your commercial auto policy's comprehensive coverage pays to repair or replace your van if it's stolen, but it does not cover what was inside it. The ladders, the power drills, the specialty equipment, the copper piping, that can be thousands or even tens of thousands of dollars worth of gear that is the lifeblood of your business. To protect those items, you need a different kind of fortification. It's usually called tools and equipment coverage, and technically, it's a form of inland marine insurance. The name is old-fashioned. It comes from a time when insurance covered goods being transported over water, so inland marine meant goods transported over land. What matters is what it does. It insures your valuable tools and equipment wherever they go. Whether they're stolen from your locked vehicle, damaged at a job site, or destroyed in a fire at your shop, this coverage is what pays to replace them. It protects the cargo, not just the ship. It covers the expensive tools, not just the toolbox on wheels that carries them. So you see, these aren't just frills. Uninsured motorist protects you from the irresponsibility of others. MedPay provides immediate care for your people. Hired and non-owned auto saves you from a lawsuit you never saw coming. And rental and equipment coverages keep your business running when disaster strikes. These are the strategic defenses that separate a fragile business from a resilient one. Because having the right fortifications is one thing, but knowing how high to build the walls is another game entirely. So how high do you build the walls? How much commercial auto insurance do you actually need? This is where so many business owners get it wrong. They look up their state's minimum liability requirements, see a number like $25,000 for bodily injury, and think, great, I'm covered. But let me be brutally honest. Relying on state minimums to protect your business is like trying to stop a tidal wave with a sandcastle. It's a catastrophic mistake waiting to happen. Those minimums were designed decades ago, and they haven't kept pace with the staggering cost of modern accidents. A single, moderately serious collision can blow past those limits before the tow truck has even left the scene. Think about it. A multi-car accident. One person has a broken leg and a concussion, requiring surgery, a hospital stay, and months of physical therapy. Another person's car, a brand new SUV, is totaled. The medical bills alone could easily top $100,000. The property damage is another $50,000. Then come the lost wages claims, the pain and suffering lawsuits, and the legal fees for your defense, which can run into the tens of thousands all by themselves. Your $25,000 state minimum limit? That's gone in the blink of an eye. And once that limit is exhausted, where do you think the lawyers for the injured parties are going to look for the rest of the money? They're coming for your business. Your bank accounts, your equipment, your property. Everything you've worked so hard to build. This is why the unofficial, but widely accepted, industry standard starting point for a commercial auto liability limit is $1 million. $1 million. It sounds like a lot, but in the world of commercial liability, it's the new baseline for survival. A $1 million combined single limit policy means that for any single accident, your insurer will pay up to $1 million to cover bodily injury and property damage claims. This single robust number provides a formidable shield against the vast majority of potential accident-related lawsuits. It's the difference between a lawsuit being a manageable insurance event and a lawsuit being a business-ending catastrophe. It sends a clear message to the world, and more importantly to potential litigants, that your business is well protected and not an easy target. But even $1 million isn't a one-size-fits-all solution. The right amount of coverage for your business depends entirely on your specific risk profile. It's a calculation based on what you have to lose and how likely you are to lose it. First, look at the value of your business assets. What is your business worth? If you have significant assets, real estate, expensive equipment, a large inventory, healthy cash reserves, you are a much more attractive target for a lawsuit. The more you have, the more you need to protect. A plaintiff's attorney will perform an asset search, And if they see you have deep pockets, they will pursue a much larger settlement. Your insurance limits should be high enough to protect the total value of your business. Next, consider the vehicles you're insuring. There's a world of difference in risk between a florist's minivan and a contractor's dump truck. The heavier the vehicle, the more damage it can cause. A fully loaded semi-truck that jackknifes on the highway can cause a chain reaction of devastating consequences that a small sedan simply cannot. You also have to consider what you're hauling. Are you transporting flammable liquids, hazardous materials, expensive client equipment? Anything that increases the potential severity of an accident needs to be factored into your liability limits. The more dangerous your cargo, the higher your walls need to be. Then, think about who is driving and how they're driving. How many vehicles and employees do you have on the road? Every single driver and every single mile driven is an added exposure to risk. A business with a fleet of 20 vans running calls all day has a dramatically higher risk profile than a consultant who uses their car twice a week to visit local clients. And what about your contracts? This is a huge one that so many people miss. If you do work for larger companies, municipalities, or government agencies, it is almost guaranteed that your contract stipulates a minimum insurance requirement. They will often demand that you carry $1 million, $2 million, or even $5 million in liability coverage, and that you name them as an additional insured on your policy. If you don't have the right limits, you can't even bid on those lucrative jobs. Your insurance coverage, in this case, becomes a key that unlocks bigger and better business opportunities. So what happens if you've done the math and realize that your risk is significant? What if you're in a high-risk industry like construction or trucking, and you know that a $1 million policy, while a good start, might not be enough to cover a worst-case scenario multi-fatality event? This is where you bring in the ultimate fortification: the commercial umbrella policy. Think of an umbrella policy as a high-level security force for your assets. It's a separate policy that sits on top of your other liability policies, like your commercial auto and general liability. It doesn't kick in until your primary policy limits have been completely exhausted. Let's say you have a $1 million commercial auto policy. You're involved in a catastrophic accident, and you're found liable for $2.5 million in damages. Your standard auto policy pays out its full limit of $1 million. Without an umbrella, you are now personally on the hook for the remaining $1.5 million. This is the moment businesses go bankrupt. But if you have, say, a $5 million umbrella policy, it seamlessly kicks in and pays that remaining $1.5 million, and you still have $3.5 million of coverage left in reserve. It is the single most cost-effective way to get massive amounts of liability protection. For a relatively small additional premium, an umbrella policy can add millions of dollars to your defensive walls, giving you the peace of mind that even a truly catastrophic event won't wipe you out. Now let's talk about the other end of the spectrum: your deductible. While the liability limit is the maximum amount your insurer will pay, the deductible is the amount you pay first, out of pocket, before your insurance coverage kicks in for damage to your own vehicles. That's your collision or comprehensive coverage. This is a crucial strategic decision. You'll be presented with a choice: a lower deductible like $500, or a higher one like $2,500 or more. The trade-off is simple. A higher deductible means you're taking on more of the initial risk yourself, so the insurance company will reward you with a lower monthly or annual premium. A lower deductible means the insurer takes on more risk from the very first dollar, so your premium will be higher. Many business owners are tempted to choose the highest possible deductible to save money on their premium. But this can be a dangerous trap. You have to ask yourself a very honest question. If one of my work trucks is in an accident tomorrow, can I comfortably write a check for the deductible amount without causing a cash flow crisis for my business? If your deductible is $5,000, but you don't have $5,000 in liquid cash readily available, you have a serious problem. Your vehicle might be stuck in a repair shop, unable to generate revenue, while you scramble to come up with the funds. The small amount you saved on the premium is now costing you thousands in lost income. The smart play is to choose a deductible that aligns with your business's emergency cash reserves. It should be an amount that is significant enough to make you a careful, risk-averse owner, but not so high that paying it would cripple your daily operations. Choosing your limits and deductibles isn't just about ticking a box. It's about creating a customized financial suit of armor for your business. It requires a clear-eyed assessment of your assets, your operations, and your tolerance for risk. You start with a strong foundation, at least $1 million in liability, and then you build up from there with higher limits or an umbrella policy based on your specific exposure. You fine-tune it with a deductible that makes sense for your real-world cash flow. So you've mapped out your fortress. You know how high the walls need to be and what you can afford for the first line of defense. But choosing the right architect, the right insurance provider, and navigating the treacherous landscape of quotes and fine print can be the difference between an impenetrable castle and a house of cards. And there are 3 specific landmines most business owners step on that can invalidate their entire policy when they need it most. The first, and by far the most common landmine, is what I call the little white lie. It's the small, seemingly harmless fib you tell an insurance agent to shave a few $100s off your premium. It sounds something like this. Meet Mark. Mark runs a successful catering business. He just bought a beautiful new cargo van. When he calls to get it insured, the agent asks him what he'll be using it for. Mark knows that if he says it's for daily deliveries, hauling heavy equipment, and traveling to events all over the state, his premium will be higher. So he tells a little white lie. He says, "Oh, it's mostly for commuting to my office and occasionally picking up office supplies." He classifies it as a personal vehicle with some business use, saving himself about $800 a year. He feels clever. He feels like he beat the system. For 2 years, everything is fine. He pays his lower premium and puts that $800 back into his business. But then comes the day of the big wedding. He's loaded the van with thousands of dollars worth of food, chafing dishes, and floral arrangements. He's driving on the highway a little stressed, running a little behind schedule. He glances at his phone for a split second to check the directions, and in that moment, traffic comes to a dead stop. He slams into the back of a brand new luxury sedan. The collision is serious. The sedan is totaled, and the driver and passenger have significant neck and back injuries. Mark is shaken, but he thinks, okay, this is what insurance is for. He calls his agent, files the claim, and waits. A week later, he gets a certified letter in the mail. It's from his insurance company's legal department. The letter is cold and direct. Their investigation found that at the time of the accident, his van was loaded with commercial catering equipment, en route to a commercial event, far exceeding the occasional office supply run, he claimed on his application. He had fundamentally misrepresented the vehicle's primary use. The letter concludes with 2 devastating words: claim denied. Not only that, but they are voiding his policy from its inception due to material misrepresentation. Suddenly, Mark isn't just on the hook for the $70,000 luxury sedan. He's personally liable for the medical bills of the 2 injured people, which are already climbing into the hundreds of thousands of dollars. He's facing a lawsuit that will target not just his business assets, the van, the kitchen equipment, the bank accounts, but his personal assets too. His house, his savings, his retirement, all of it gone, wiped out, because he tried to save $800 a year. This isn't a scare tactic. It's a daily reality in the insurance world. The primary use of the vehicle, be it delivery, construction, passenger transport, or sales, is the absolute bedrock of your policy. Lying about it isn't a clever loophole. It's like building your fortress on quicksand. The moment you need it to stand firm, it will swallow you whole. The second landmine is the phantom driver. This one is even more insidious because it often happens without any malicious intent. Let's look at Sarah, who owns a growing landscaping company. She has 2 trucks and 3 full-time employees, all of whom are officially listed as drivers on her commercial auto policy. Business is booming, so she hires a temporary summer helper, a college kid named Jake. Jake is a hard worker, and Sarah trusts him. One afternoon, she's short on mulch for a big job. The supplier is just a few miles down the road. Her other 2 drivers are out on other sites. So she says, "Hey Jake, can you take truck 2 and go grab 10 bags of mulch? Here are the keys." It's a simple, logical business decision. Jake hops in the truck and heads out. On his way back, a car runs a red light and T-bones the truck. Jake is okay, but the truck is heavily damaged and the other car is a wreck. Sarah calls her insurance company, confident she's covered. She has a great policy after all. The claims adjuster is very polite. He asks for the details and then he asks the critical question: who was driving the vehicle at the time of the accident? Sarah says, "Oh, that was Jake, my summer helper." The adjuster pauses. He types something into his computer. "I'm sorry," he says. "I don't see a Jake listed as a driver on your policy." Sarah's heart sinks. She explains he's just a temporary employee, that she just hired him. The adjuster's tone remains professional, but the message is brutal. Her policy contains a very specific clause, as most do, called the unlisted driver exclusion. It states that coverage does not apply if the vehicle is being operated by a driver who is not explicitly named on the policy schedule of drivers. The claim is denied. Sarah is now responsible for tens of thousands of dollars in repairs to her own truck, plus any liability from the other vehicle, all because she didn't make a 10-minute phone call to her agent to add Jake to the policy. Insurers need to know who is behind the wheel. They need to run a motor vehicle report, check their driving history, and assess their risk level. A new driver, especially a young one, can change the entire risk profile of your business. Hiding a driver with a bad record, or simply forgetting to add a new one, is a gamble you cannot afford to take. Every single person who might, even in an emergency, get behind the wheel of a company vehicle must be on that policy. No exceptions. The third and final landmine is the most technical, but it's just as deadly. It's the myth of the imaginary border. Let's consider a small logistics company, Rapid Courier, based in Cleveland, Ohio. When they set up their commercial auto policy, the agent asked them about their radius of operation. This is the typical distance their vehicles travel from their home base. To keep the premium low, the owner said, "Oh, we stay local. Keep it within a 50-mile radius." For the first year, that's true. They handle local deliveries around the Cleveland metro area. But then they land a massive, game-changing client. This new client needs them to run dedicated routes to Pittsburgh, Pennsylvania, about 130 miles away. The money is too good to pass up. They start running the Pittsburgh route daily, their profits soar, and they completely forget to update their insurance agent about this major change in their operations. 6 months into the new contract, one of their drivers is on the Pennsylvania Turnpike, just outside Pittsburgh, when a tire blows out. The van loses control, crosses the median, and causes a multi-car pileup. It's a catastrophic accident. The owner of Rapid Courier files the claim, the biggest in his company's history. The insurance investigator starts looking into the details. He pulls the vehicle's GPS logs, the driver's logs, the shipping manifests for that day, and he sees a crystal clear pattern. For 6 months, this vehicle has been operating 130 miles from its home base, making daily trips to Pittsburgh. It was well outside the 50-mile radius of operation declared on the policy. The result is the same nightmare we've seen before. A certified letter arrives. The claim is denied. The policy is voided. The reason? Material misrepresentation of the operational territory. Insurance premiums are calculated with mathematical precision, based on risk. A vehicle operating in a 50-mile local radius faces predictable risks, local traffic, familiar roads. A vehicle operating in a 500-mile radius faces entirely different risks, interstate highways, varied weather patterns, driver fatigue, different state laws. By expanding their territory without notifying the insurer, Rapid Courier fundamentally changed the risk the insurance company had agreed to cover. They crossed an invisible border on their policy, and in doing so, they walked into a financial wasteland with no coverage at all. The lawsuit that followed didn't just bankrupt the business. It led to personal ruin for the owner. These 3 landmines, the little white lie about vehicle use, the phantom driver, and the imaginary border, all share a common trigger: a failure to communicate. Your insurance policy isn't a document you sign once and forget about. It is a living agreement that must evolve with your business. Every time you change how you use your vehicles, who drives them, or where they go, you must update your insurer. The temporary savings from hiding the truth are an illusion. The real cost is measured in devastation when that truth inevitably comes to light at the worst possible moment. Avoiding these mistakes is the first step. But the next step is just as critical. It involves understanding the numbers that actually define your protection, the policy limits. Because choosing the wrong numbers, even with the best intentions, can leave you just as exposed as telling a lie. And there's one number in particular that almost every new business owner gets wrong. That number is the state minimum liability requirement. And if you're building your commercial auto policy based on that number, you're building your business on a foundation of sand. Let me be crystal clear. The state-mandated minimum insurance is not a recommendation. It is not a suggestion for adequate coverage. It is the absolute, bare minimum legal threshold you must cross to put a commercial vehicle on the road without getting fined or having your registration suspended. Think of it like the minimum wage. It's the legal floor, but very few people would argue it's enough to build a secure financial future on. Relying on state minimums to protect your business is financial insanity. Let's break down why. Most state minimums are written in a series of 3 numbers: Something like 25/50/25. Sounds official, but what does it actually mean? The first number, 25, stands for $25,000. That's the maximum your insurance will pay for bodily injury to a single person you injure in an accident. The second number, 50, is $50,000. That's the maximum total your policy will pay for bodily injuries for everyone in the other car, combined, for a single accident. And that last number, 25, is $25,000 for property damage. That's the most your policy will pay to repair or replace any vehicle or property you damage. $25,000 for property damage. Take a moment and look around you the next time you're in traffic. The average price of a new car in the United States is over $48,000. You tap the bumper of a brand new Ford F-150, a Tesla Model 3, a new Suburban, and your $25,000 state minimum limit is exhausted before the tow truck even arrives. And that doesn't even account for multi-car accidents. What if you swerve and hit two cars, or cause a chain reaction? That $25,000 is supposed to cover everything. It's a joke, but the property damage is often the least of your worries. The real business killer is the bodily injury limit. $50,000 total for everyone in the other car. Imagine you cause an accident with a minivan carrying a family of 4. One person suffers a broken leg. The ambulance ride alone can be $2,000. The emergency room visit, x-rays and setting the bone? $10,000 to $15,000 easily. Follow-up appointments and physical therapy? Another $10,000. We're already at $27,000 for one person with a relatively common injury. But what if their spouse in the passenger seat suffers a concussion and a back injury? Now you have MRI scans, specialist visits, potential surgery. Their medical bills could hit $100,000 all by themselves. Your policy covers a grand total of $50,000 for the entire family. Who pays the rest? You do. Your business pays it. And if your business can't, they will come after you personally. To make this real, let's talk about Mark. Mark runs a small, successful plumbing company. He's got 2 vans on the road. He's a good guy, works hard, and he's smart. He knows he needs commercial auto insurance. He calls an agent, gets a quote, and sees the price difference between a state minimum policy and a policy with higher limits. He thinks, my guys are safe drivers. We're just driving around town. Let's save a few $100 a year and go with the minimums. He gets a 25/50/25 policy. One Tuesday afternoon, his best employee, Dave, is driving the company van to a job. He's on the highway. Traffic suddenly slows. Dave glances at his GPS for a split second, and when he looks up, it's too late. He slams into the back of a new Honda Odyssey minivan. The impact shoves the minivan forward into a brand new Lexus sedan in front of it. A 3-car pileup, and Dave is at fault. Let's do the math on Mark's really bad day. The Lexus has significant rear-end damage. The repair bill is $32,000. The Honda Odyssey minivan is totaled. Its replacement value is $45,000. The total property damage is $77,000. Mark's state-of-the-art, legally compliant insurance policy pays out $25,000. Mark's plumbing business is now on the hook for the remaining $52,000. That's the cost of a brand new work van gone. But it gets worse. In the Lexus was a single driver, a lawyer, who now has severe whiplash and is out of work for a month. His medical bills and lost wages claim comes to $30,000. Mark's policy has a $25,000 limit per person. So, the policy pays $25,000, and Mark's business owes the other $5,000. Now for the minivan. Inside was a mother and her 2 children. The mother suffers a herniated disc in her back, requiring surgery. Her medical bills alone are over $120,000. The 2 children have minor injuries, cuts and bruises, but are deeply traumatized. The family hires an attorney. The total claim for bodily injury for the family in the minivan is now climbing towards $200,000, accounting for medical care, pain and suffering, and ongoing therapy for the children. What does Mark's policy pay for them? The per-person limit is $25,000, but that doesn't matter here. The total per accident limit is $50,000. That is the absolute maximum the insurance company will pay for everyone in that van combined. So, of the $200,000 in claims, the insurance pays $50,000. Mark's business is now personally liable for the remaining $150,000. Let's add it all up. $52,000 for the leftover property damage, $5,000 for the lawyer's claim, $150,000 for the family in the minivan. Mark, by trying to save a few $100s on his premium, is now facing a bill for $207,000. His business checking account is wiped out. They put a lien on his business assets, his tools, his equipment, his second van. It's not enough. So the lawyers go after him personally. Depending on his business structure, they could come after his personal savings, his investments, even his house. His dream of building a business, of creating a legacy for his family, is vaporized in a single instant. All because he chose a number dictated by politicians instead of a number dictated by reality. This isn't a scare tactic. This is the reality of a single moderate accident in the United States today. So what is the right number? For virtually any legitimate business, the absolute floor for your liability coverage should be a $1 million combined single limit. $1 million. A combined single limit, or CSL, is different from the 25/50/25 structure. It's one big pool of money. In Mark's accident, that $1 million policy could have paid the $77,000 in property damage, and then paid the $30,000 for the lawyer, and the $200,000 for the family, and there would still be hundreds of thousands of dollars left over. Mark would have written a check for his deductible, and that's it. His business would be safe. His home would be safe. His future would be safe. Now you're thinking, $1 million policy must cost a fortune. And this is the craziest part. Doesn't. The cost to go from a dangerously low limit like a $5,100 policy up to a $1 million CSL is often shockingly small. You might be talking about a few hundred extra dollars a year. It is, without question, the single greatest return on investment you can make in the security of your business. You are buying $1 million of lawsuit and bankruptcy protection for the price of a few fancy dinners. Choosing state minimums is like going into a sword fight wearing a t-shirt. You're technically clothed, but you are not protected. A $1 million CSL is your suit of armor. It's the baseline. It's the standard for any serious business owner who understands that the cost of an accident isn't measured by your insurance premium, but by the life you've worked so hard to build. Protecting yourself from others is the most critical part of your policy, but it's only half the battle. Because even if you're fully protected from lawsuits, one hailstorm or one stolen truck could still put you out of business overnight. And that's where the other side of your policy comes into play. This is the part that protects your assets, your vehicles, the lifeblood of your operation. We're talking about physical damage coverage, and it's typically broken down into two critical components: collision and comprehensive. Let's start with collision. It's exactly what it sounds like. It pays to repair or replace your vehicle if it's damaged in a collision with another object, whether that's another car, a guardrail, a light pole, or even if your driver accidentally backs into your own building. It doesn't matter who is at fault. If your truck hits something, or something hits your truck, collision coverage is what pays to fix your truck. Think about it. You run a plumbing business. Your best technician is driving your brand new, fully wrapped Sprinter van to an emergency call. He's trying to navigate a tight downtown street, misjudges a corner, and scrapes the entire passenger side against a concrete pillar in a parking garage. It's a $40,000 van, and the repair bill is $12,000. Without collision coverage, that $12 grand comes directly out of your pocket. Comes out of your profits, your ability to make payroll, your plans for expansion. With collision coverage, you pay your deductible, say $1,000, and the insurance company handles the rest. You get your van back on the road, making you money instead of sitting in a body shop costing you money. But what about all the things that can happen to your vehicles when they aren't moving? That's where the second half of this shield comes in. Comprehensive coverage. This is sometimes called other than collision coverage, and it's your protection against the chaos of the world. We're talking theft, vandalism, fire, falling objects, floods, and hailstorms. Imagine you own a small fleet of delivery vehicles. You park them in a secure lot overnight. You come in one morning to find that thieves have cut through the fence and stolen every single catalytic converter off your trucks. The replacement cost is thousands of dollars per vehicle, not to mention the downtime while they're being repaired. That's a comprehensive claim. Or picture this. A freak hailstorm rolls through your town. The golf ball-sized hail turns the hoods and roofs of your entire sales team's sedans into cratered moonscapes. The damage across 5 cars is $30,000. That's a comprehensive claim. A tree branch falls and shatters the windshield and crushes the roof of your parked pickup truck? Comprehensive. Someone spray paints graffiti all over your box truck? Comprehensive. Your vehicle is stolen and never recovered? That's the ultimate comprehensive claim. Without this coverage, the Every single one of those incidents is a direct, catastrophic hit to your company's finances. With it, you pay your deductible and you get back to work. Liability protects you from the world. Physical damage protects you from the world. Together, they form the core of your commercial auto policy. But we're not done. A great policy isn't just about these two pillars. It's about filling in the gaps, because the gaps are where businesses go to die. One of the biggest gaps is created by other people on the road. What happens when your driver does everything right, but they get hit by someone who has no insurance or not enough insurance? This is a terrifyingly common scenario. The Insurance Research Council estimates that 1 in 8 drivers in the United States is uninsured. That's nearly 13% of everyone on the road. And many more are driving with the absolute bare minimum liability limits required by their state, maybe just $25,000. If they seriously injure your employee and total your $60,000 truck, their tiny policy won't even begin to cover the damage. This is why you absolutely need uninsured and underinsured motorist coverage, or UM/UIM. This coverage steps in and acts as the insurance the other driver should have had. It pays for your employee's medical bills under uninsured motorist bodily injury. It pays to repair or replace your vehicle under uninsured motorist property damage. When the person who hit you can't pay, this part of your policy pays you. To operate a business vehicle without it is a gamble you cannot afford to take. And speaking of medical bills, you should also have medical payments coverage, or MedPay. This is a simple, powerful coverage. It pays for initial medical expenses for you or any passengers in your vehicle who are injured in an accident, regardless of who is at fault. There's no waiting for lawyers to argue or for fault to be determined. Someone gets hurt in your company car? MedPay can immediately start covering ambulance rides, emergency room visits, and co-pays. It's goodwill, it's fast, and it shows you take care of your people. Now, with all these pieces in place, liability, physical damage, UM/UIM, MedPay, you might feel like you've built an impenetrable fortress around your business. And you're close. But thousands of business owners who buy these exact policies still make one fundamental, critical mistake. They treat their insurance policy like a product they buy once and then file away. They set it and forget it. This is the single most dangerous thing you can do. Your business is not static. It's a living, breathing organism. It changes. You hire a new employee. You buy a new truck. You sell an old van. You start offering a new service that takes your drivers into a different state. You sign a big contract that requires you to carry higher liability limits than you currently have. Your insurance policy is not a certificate on the wall. It is a dynamic tool that must be adjusted and maintained just like any other critical piece of equipment in your company. You must review it at a minimum once a year with a qualified agent. But more than that, you need to think of your agent as a partner in your business. The moment you think about adding a vehicle, you call your agent. The moment you hire a new driver, you call your agent to get them approved and added to the policy. Before you sign a major contract, you send the insurance requirements section to your agent to make sure you're in compliance. This isn't about creating more work. It's about preventing disaster. The 5-minute phone call you make before you let a new hire drive your truck is infinitely less painful than the call you'll have to make after they get in an accident and you discover your policy won't cover them. So, how do you do this right? How do you move from just having insurance to being properly insured? First, you need to get organized. Gather the essential information. A list of all your vehicles with their VINs, the full legal names and driver's license numbers for every single person who might drive for your business, and a clear idea of how far and where you typically travel. Second, and this is the most important step, find an independent insurance agent who specializes in commercial lines. I want to repeat that. An independent agent who specializes in commercial. Why? A captive agent works for one company. They can only sell you that one company's product. But an independent agent works for you. They represent multiple insurance carriers and can shop the market to find the best combination of coverage and price for your specific operation. A specialist in commercial insurance understands the unique risks a business faces. They know the right questions to ask and the right endorsements to add. They are your guide and your advocate. Third, when you talk to that agent, don't just ask, "How much will it cost?" Ask better questions. Ask, "If my employee gets in an accident in their personal car while running a work errand, am I covered?" Ask, "What happens if a tool falls off my truck and causes a multi-car pileup?" Ask, "What are my deductible options and how does that affect my premium?" Ask them to walk you through the quote, line by line, and explain what every single coverage does in plain English. Remember, the cheapest policy is almost always the most expensive one when you actually need it. The goal isn't to find the lowest price. The goal is to find the best value. The right protection that will allow your business to survive a worst-case scenario. Because that's what this is all about. This isn't just a piece of paper. It isn't just an annoying expense you have to pay every month. It's a promise. It's a promise to your employees that if they get hurt on the job, they'll be taken care of. It's a promise to your family that one bad day on the road won't destroy the business you've sacrificed everything to build. It's a promise to yourself that your dream is protected. Getting the right commercial auto insurance is one of the most important business decisions you will ever make. It's the firewall between a simple mistake and total financial ruin. It's the foundation that allows you to build higher, expand further, and operate with confidence, knowing that you are prepared. Don't guess. Don't hope for the best. Take control. Make the call, talk to a professional, and put the right shield in place. Protect your vehicles. Protect your business. Protect your future.